Most people know exactly what their investment accounts are worth, but very few know how much of an estate they're leaving behind for their family. After taxes, probate, and other estate costs, the difference can be hundreds of thousands of dollars or even millions of dollars. That's what I call estate shrinkage. Hey everyone, welcome back to the channel. I'm Martin Cloutier from Prestige Private Wealth Management. There are a lot of important numbers in financial planning, but one that often gets overlooked is what I call estate shrinkage. It's simply the difference between what your estate is worth and what your family actually receives. So let me ask you one question. If something happened to you tomorrow, do you know how much your estate would disappear to taxes and probate, and how much your family would actually receive? Because most people don't. Let me show you what I mean. On the left side of the screen is a real planning scenario based on one of our fictional clients, Gordon Murray. Without any strategic planning, this couple passes away with an estate worth $6.5 million. At first glance, that sounds fantastic, but that's not the number their family receives. Take a look at what happens. Over $2.4 million disappears to income taxes. Then there's another $96,000 in probate fees. By the time everything is settled, the family receives just under $3.9 million. I know it's still a lot of money, but the point is that 40% of the estate disappears before the beneficiaries receive a dollar. That's estate shrinkage. Now, before we get into the details regarding this family's financial planning, if you're finding this video helpful, make sure to smash that button below and subscribe so that you'll get notifications as to when new videos come out. And if you know someone who could benefit from the conversation, feel free to share it with them. Now, let's look at this family's results after some coordinated financial planning. Interestingly, the estate itself is actually smaller, and some people see that immediately and they think something's wrong. But in reality, it's exactly the opposite. And here's how. During retirement, we intentionally withdrew registered assets over time and redirected surplus funds into a tax-efficient structure. Taxes were paid gradually over the years instead of all at once at death. The result is a smaller taxable estate, but a much larger inheritance. Now, look at the bottom of the report. Instead of the family receiving $3.9 million, they received just over $5 million. That's more than $1 million of additional wealth ending up in the hands of the family, not because the investments earned more, but because the planning was better. Here's the part that you really need to remember. The goal isn't to die with the biggest estate. The goal is to leave your family with the biggest inheritance. Those are not always the same thing. In fact, I think every retirement plan should answer one simple question. How much estate shrinkage are you leaving on the table? Now, you'll also notice something else on the report. Estate shrinkage. Without planning, almost 40% of the estate disappears. With planning, that shrinkage drops to about 1%. Now, I want to be very clear. We didn't eliminate taxes. What we did was we reduced unnecessary estate shrinkage through coordinated planning, and that's an important distinction. Now, before everyone outside of Ontario clicks away, this example uses Ontario's probate system, but planning principles apply across Canada. The rules vary from one province to the other. BC, for example, has one of the more significant probate fee structures. Alberta's probate fees are relatively modest, while Manitoba doesn't have probate fees at all. And then there's Quebec. Quebec has completely different estate administration system, and the remaining provinces each have their own rules, fees, and structure. So while the probate numbers will change depending on where you live, the planning principles don't. Understanding how taxes, probate, and beneficiary designations affects your estate can help more of your wealth end up in the hands of your family. One of the simplest planning opportunities is making sure your beneficiary designations are up to date. Registered accounts like TFSAs and RSPs can often pass directly to named beneficiaries instead of flowing through your estate. In many cases, that can simplify administration and reduce probate costs. Some financial institutions also allow you to name contingent beneficiaries. That means that your primary beneficiary, if they die before you've already identified who should receive those assets next. But, and this is an important but, that isn't automatically the right answer for everyone. That's why beneficiary designations should never be completed in isolation. They should always be completed in coordination with your will and your overall estate plan. They should be coordinated with your financial advisor and with your lawyer. This is also why good financial planning isn't about one magic strategy. It's about a combination of many small decisions all working together. Better RIF withdrawals, thoughtful TFSA use, appropriate beneficiary designation, tax planning, and estate planning. Each one might seem relatively small on its own, but together they dramatically improve your outcomes for you and your family. Don't judge your estate by what you own. Judge it by what your family keeps. Financial planning isn't just about the numbers, It's about what those numbers can make possible for you and your family. It's about enjoying your life today while making smart decisions for tomorrow. It's about paying attention to both the financial scoreboard and the happiness scoreboard, reducing unnecessary taxes, making the most of your hard-earned money, and leaving more behind for you and the people that you love instead of leaving that money to CRA. And that's how we're helping you to live for today while planning for a better tomorrow.